Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, more just monster numbers being thrown about in this AI game. OpenAI to raise $110 billion in new investment at a $730 million pre-money valuation. Extraordinary amounts of money being raised. All the big names are involved here. I need a little help. We all need a little help here. Caroline Hyde, BTech Co-Anchor, joins us here in our Bloomberg Interactive Broker studio. The hits keep coming, Caroline. I mean, the investments keep coming, and from big names we all know. What do you make of it?
It makes for an interesting relationship of OpenAI and Microsoft going forward, because This is Amazon coming in, which already has a very strong relationship with Anthropic, remember. And we've seen a lot of crossover of big strategic investors and venture capitalists in putting money into both key frontier labs. What's interesting in this agreement is not only the whopping scale of money, 50 billion is going to be coming from Amazon. Now, we don't quite know if that is pure cash or actually whether it's more in cloud costs that just get sucked up by Amazon instead, or indeed whether it's GPUs and chips. But we also think that 30 billion is coming from NVIDIA, so the deepening tie continues there, and clearly therefore some GPUs from NVIDIA are going to be intertwined in OpenAI's compute needs, as well as Amazon's own Trainium chips and the likes. But we're also seeing, well, as well as Masayoshi Son being a big player in all of this, Microsoft being less of a player. And remember, OpenAI first got its big chunk of change from Microsoft. Microsoft was the key backer of the company, had exclusive rights to a lot of OpenAI's technology within the Azure platform. Well, now the frontier offering coming from OpenAI, that's basically the new offering to help build agents, which is all anyone can talk about at the moment. That's going to be exclusive on AWS.
Oh, wow.
So all of this is just an interesting rearrangement of technology partners and just how people are deepening their ties.
I like your word rearrangement, because we have OpenAI CEO Sam Altman saying that he doesn't think his company's fundraising is looking, quote, circular, as long as revenue keeps going. And I feel like this is a conversation we've been having. It's like the self-funding loop. And is it risky? But he's saying it's not circular.
Well, NVIDIA's had to try and prove this point time and time again. NVIDIA has been putting money into neo-clouds like CoreWeave, which had its numbers today, putting money into the likes of an Anthropic and an OpenAI, which ultimately all want chips from NVIDIA. But many would say, look, it's not just circular financing, it's actually strategic financing, because how better to understand how your technology works best is if you partner this closely and you can understand the way in which your GPUs, your CPUs will be used in the future. So for the cynics among us, yes, it looks like the same big players are all moving money from one place to the other within each other. But for perhaps the more practical, it's like, well, who else has the cash pile to be able to continue to build the flywheel effect of generative AI here at the moment? And OpenAI has an enormous amount of compute needs. That's what they keep saying time and time again. Sarah Fryer is the CFO, Sam Altman is the CEO, saying the thing that's holding back our revenue, and remember they guided us to a new kind of revenue stratosphere of 280 billion by next year. The way they get there is by compute increasing, not anything else. They've got all the parts they need to build revenue from the 12 billion that they made in 2025. But what they really need is the galvanization of infrastructure. And that comes from power and that comes from compute.
I mean, OpenAI says ChatGPT has more than 900 million weekly active users, more than 50 million consumer subscribers, and more than 9 million paying business users that rely upon ChatGPT. That's deployment. Are they the biggest yet? I'm not even sure how we define the market, but are they the biggest in
consumer for sure? Yes. Like in terms of like this, the size and scale of people using. The problem is of course Google. How are you measuring Google? Many would say, like, is it the person my mum who goes onto Google search and gets an AI overview? Or is it someone who downloads the Gemini app and uses it in a distinct kind of model? So there's two ways in which you can compare and contrast. But certainly OpenAI has beaten out Anthropic from how many people are using their standalone application. 900 million is a huge amount. But from an enterprise perspective, many would say Anthropic has led the charge there. And that's why OpenAI has really been doubling down on this agentic focus. And AWS is going to be core to that, putting it within Bedrock.
There's also a headline from Anthropic. They're refusing the Pentagon's latest contract terms. They want to limit surveillance and autonomous weapons. Are those reasonable asks for a company supplying AI to the military?
The military would say no. The military would say Lockheed Martin has no power over us to dictate how we use the weapons. We just purchase them and use. And there are laws that we have to abide by, and there's humanitarian things that we sign up for, and the way in which we police war worldwide. However, from Anthropic's perspective, and if you'd been keeping up with what Dario Amodei, the CEO, has been writing of late, he put out a big piece, thought leadership piece in January, talking about the adolescence of technology and his worries and concerns about geopolitics, the use of generative AI for surveillance, the use of generative AI in biotech and warfare. So no wonder he's still thinking along these lines. He's given us all the breadcrumbs to know that this is how he feels. They just earlier in the week, remember, sort of put out this odd statement saying they're stepping back from some of their safety as a core mission purpose. But within that statement, they really made clear it's because the government doesn't care. The government has not been increasing their focus on AI ethics in the way that they thought they would.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Dell Technologies shares, they jumped pretty big here after the company gave an outlook for sales of its artificial intelligence servers that exceeded estimates. As John said, the stock's up 19.4% today. Not bad for a big company with $97 billion in market cap. Jin Ho joins us here, senior technology analyst for Bloomberg Intelligence. That's a serious print for Dell. What's going on there?
I mean, John just said, look, you're having these massive investments from OAI, right? OAI. So essentially, you're all of these data center deployments are really starting to materialize, and Dell's starting to benefit from it.
And they're entering the year with a $43 billion backlog. Does that give investors real visibility, or is the backlog vulnerable to supply chain constraints and maybe pricing resets?
Well, I that's a fantastic question, right? On the pricing reset, I don't think so. I think there's a little bit of leverage on Dell's side because NVIDIA is holding the cards with the GPU chips, right? But in terms of the supply environment, Dell does the supply chain very, very well. And the revenue guidance, not only for the AI server side, but also traditional servers and PCs, they're managing it a lot better than we thought. So they should be fine on the supply side for the rest of the year.
How big is the AI-related product revenue for Dell, and how has that grown, and what do you expect it to go to?
Well, if we think about just the AI server piece by itself, it is $25 billion for this year, doubling to $50 billion. I mean, we're talking about incredible numbers, doubling to $50 billion next year. We've also seen that sort of momentum from Supermicro as well, that they reported a couple of several weeks ago. But on the AI PC front, it is starting to pick up steam. Still a small portion of the business, but quite frankly, every PC is eventually going to be an AI.
So what's
PC.
an AI PC? What is that practicality?
Yeah, I'll tell you, in practicality, very little for you and I.
Okay.
Right? It's a chip that can handle a lot more processes and do it a lot faster. Right. I've actually been playing around with Cloud Code as part of my work. And essentially what I'm doing is trying to use some of the processing that's on the PC. What I suspect is that as corporates try to bring in AI into their workflow, they are going to look specifically for AI PCs going forward.
The company says memory chip prices are rising rapidly. Do you think that the margins in those segments will be sustainable if the component prices also keep climbing?
Yeah, so I think this is one of the reasons why the stock is up so much, right? The sentiment going into the print was really, really negative, primarily because of the component and memory pricing. HP said on just the other day that their memory pricing doubled over the past month, DRAM pricing alone, right? So that ate away at margins. We actually did the math. Memory pricing plus a higher mix of AI servers, that's eating away 100 basis points of gross margin. And the thing is that just the relative scale of the AI server revenues is helping to lift EPS altogether.
So talk to us about the shortage of chips out there, because we hear from a lot of your companies and other companies in the tech stack What is it? Why is it? And how does it get fixed?
We can blame AI on everything.
Yes.
Right? So essentially, AI servers take, they use HBM, high bandwidth memory that's stacked, and it's sucking up a lot of the memory capacity that's out there. If we come off of the COVID period, essentially the memory makers, whether it's Micron's, SK Hynix, or Samsung, they were hesitant to building out more capacity because they just didn't know if this AI thing was going to be real. And now it's starting to catch up to them. It's causing this domino effect of everything else. Servers, smartphones, PCs, they're just scrambling for supply right now.
How do you read the buybacks around $10 billion? Is that confidence in future cash flow or more like, oh no, the stock is still undervalued?
Well, when the stock was at 120, I'm sure Michael Dell thought the stock was undervalued and wanted to breed a lot more confidence, not only in the business outlook, but also in the cash generation. Right? We are hearing mixed things on the cash generation front from my hardware companies, at least.
Did IDC take down? IDC is the third-party independent data provider for pretty much the whole technology industry. Did they take down their forecast for PCs, was it?
Took them long enough.
Yeah.
We had minus 7% unit declines.
Is that because there's not enough chips to make the PCs?
It's twofold, right? Not enough chips. And number two, PCs are very, very elastic, right? From a supply-demand perspective. And essentially what they did was they cut their forecast from minus 3% to minus 11% on the PC side. And they also cut their forecast to smartphones to minus 13%.
Oh, right.
Right? There's a couple of things going on. The PC makers are going to focus more on the high margin businesses, right? So it leaves the lower end PCs at a large, so they're not going to start supplying those. And also the low end market tends to be a lot more price sensitive, so they're probably not going to upgrade.
And then we have server and networking margins. I think those came above expectations. Is Dell gaining pricing power in AI hardware, or is it just because maybe they're executing better than their peers? How do you read that?
Yeah, so there's a couple of things going on, Isabelle. The first thing is that they're raising prices, right? And the term sheets are getting shorter. Instead of 3 months, it's to 2 weeks. So that's happening as well. It's less price elastic. And then on top of that, from a margin perspective, as you were talking about earlier, storage has a higher margin overall. And the storage business actually is doing very, very well, quite frankly.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Got big earnings yesterday. CoreWeave, and it wasn't good because the stock fell by the most in more than 6 months. That's after the company reported a better than expected loss and boosted capital expenditures. So this spurred some concerns that the company is overspending on infrastructure. And who else can talk to us about this better than Anurag Rana? He's Bloomberg Intelligence technology analyst all the way from Chicago. So Anurag, revenue exploded to $1.9 billion last year, but losses widened. Is this a classic growth at any cost when it comes to the AI story, or is it something a little more concerning?
Yeah, I mean, that's what the CEO is saying, that, listen, we have so much back orders of, $60+ billion in orders, and we really need to fill it. And we're going to go spend as much as we can. And today, it seems investors are not liking it. But, I think what happened was they gave a bit of a outlook of what the expenses are going to be, and they missed on that. And I think people are extremely, no, I wouldn't say extremely, but somewhat concerned that, whether they have the capital down the road to keep on continuing this particular flow. I think that's really what it comes down to, is where is the profitability going to come and at what point? Because as we know, some of these businesses, you have to invest up front and then realize the profit later.
Yeah, you got to back up for me and explain the basics. What in God's name is a neo cloud?
Yeah, well, that's just a nomenclature. But at the end of the day, this is just a cloud. What you do is you open a data center, you buy GPUs from NVIDIA, and then you rent it out to people. It's a very simple business model, nothing so complicated about it. But what happens is you need to put that upfront capital. to create that data center. Then you need to buy the chips and put it in there. And then after that is what you start realizing the revenue when people use it. We have enough evidence that the backlog of that is absolutely stellar right now. There is so much demand. These guys are running around and trying to, put the data centers together and then go out and service that. So there is a mismatch between how much you're putting in terms of cost versus what's coming in as revenue.
Well, can you explain a little further? How interwoven are they with NVIDIA at this point, and what's the significance of that?
Well, think of this as NVIDIA is selling the chips. They are really the distribution arm for the services around it. NVIDIA is a shareholder in CoreWeave, and this is a pure play, you could say, NVIDIA shop, where it's basically going out and renting their chips out there. Now, it is, and again, this is not so much NVIDIA trying to just, give them capital to stay in business. They actually have orders from everybody, whether it's Microsoft or Meta or a lot of enterprises as well. So, CoreWeave has real orders that it needs to fulfill. The question, again, as I said, is how much you have to put up front for those chips and services versus how much you're going to realize as revenue.
And 77% of revenue came from just two customers, with Microsoft accounting for nearly 2/3. How big of a red flag is that, or if it's even a red flag for IPO investors?
No. Yeah, to me, it's not a red flag. It is a concentration issue. I get that. But at the end of the day, I think Microsoft is good enough in terms of, they will pay the bill to CoreWeave if they have promised some revenue. So I'm not concerned about that part. But CoreWeave is now seeing a lot more demand from other vendors. That's also not an issue. As I said, this is not a demand issue. The question at hand is, because one of the things CoreWeave has to do is it has to go out, borrow money, issue some bonds, and then go out and create new data centers. So it's a financing question, how much the rate of that is going to be, how much they're going to charge for these services. So, it's pretty much most of a cost overrun story at this point.
Do they give much clarity on when this is all going to pay off?
They basically said, listen, long-term margins are very good. They are expecting margins to improve in the second half of 2026. But, they gave some guidance for operating income or adjusted operating income for 4Q, and they came below that. So the big question for the analyst is, you are telling me that it's going to improve in the second half of 2026. What if it doesn't happen? So I think there are some doubts around that capabilities at this point.
And So the company could ask for a valuation north of $35 billion in this market. Do you think that's justified by the fundamentals, or do you think it's kind of driven by AI momentum?
I think the question always happens is, 1 week, the entire AI infrastructure world is very happy and, bubbly. And then the next week, people start getting concerns. The question, what CoreWeave has to show right now is they have to go out and raise some debt. That's tied to their contracts. And we'll see what's the cost of that debt, because that's going to dictate how the next funding is going to be, or I call it not so much a funding round, but more so a debt raise round, and how that's going to go about.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's dig into deeper this little deal there in the media space. Warner Brothers Discovery, again, the news of being Netflix walking away. So now Paramount Skydance, it's their deal. Good for them. And let's check in with Geetha Ranganathan. She covers all the media stocks for Bloomberg Intelligence. Geetha, we got Netflix stock trading higher. I guess the shareholders like them kind of passing on this deal.
Yeah, big relief rally, Paul. This was always kind of muddying the narrative. We've spoken about this multiple times. Netflix is such a clean, organic growth story, and them just pursuing Warner Brothers Discovery, just kind of added so much of uncertainty. You have the regulatory risks, of course, integration, execution risks. Plus, we were talking about something like, their debt levels going up to beyond $100 billion. And yes, they do have the financial firepower, but at the end of the day, they have always been builders versus buyers. And once again, they showed, that they deserve, they've always gained this reputation of being very, very disciplined spenders when it comes to M&A. And I think they once again exercised that discipline, and investors are cheering.
So it seems that this is a smart move, according to analysts, including you. Does this signal that the company is confident in its organic growth versus M&A, especially in a very crowded streaming market?
Yeah, Isabelle, I mean, that had, been the question. I think that's what spooked investors so much when they actually went ahead with this $83 billion deal for Warner about whether they were actually seeing a slowdown internally, and them not just abandoning the deal, but also going ahead and resuming buybacks. Once again, just kind of signals confidence in their underlying growth model. So I think, we know very well that their operating metrics are really strong. I mean, this is a company that has guided to double-digit revenue growth. We're going to see about 12 to 14% revenue gains this year. We're looking at operating margin expansion of almost 1,000 basis points. It's gone up 10% over the past 2 years. So, and of course, we also have fabulous, free cash flow generation. So all of their, financial levers and all of their growth drivers very much in place. Not having this distraction anymore just helps them kind of really double down on their organic growth story.
On the other side of the equation, Geetha, be careful what you wish for. So Paramount, they've got this great asset in Warner Brothers Discovery. What's the street think about this management team at Paramount? It's pretty much unknown, untested. This Mr. Ellison from the media community. Is there any report card to date? Does the market think that this is a management team that can make this acquisition work?
They probably can, Paul. I mean, they do have, financial. They do have some financial firepower here, although I would point out that leverage at this company is going to be extraordinarily high. We're looking at pro forma leverage of around almost 7 times. So those are, dangerously high levels. Yeah, and it's something that they're going to have to contend with. But at the same time, they have spoken to synergies. We're looking at about $6 billion in synergies that they've committed to. And remember, this is a team with a fairly tech-heavy bent. So that might be something that kind of really serves them well as they poise themselves for this new streaming future. You do have now, they kind of are turbocharging their content offering, they're turbocharging their streaming business, and they have all of the pieces in place to make this a really good business. We'll have to wait and see how they execute. But you're right. I mean, the management team is a little bit of an unknown, although we do have Jeff Shell, who has experience from NBC. But again, it's going to be a little bit of a wait and watch.
And Netflix also said they plan to invest $20 billion this year in films and shows. Is that enough to keep them ahead, again, in this really competitive streaming wars?
Yeah, the $20 billion that they committed was actually a pretty significant step up, Isabelle, from prior years. I mean, we've seen them increasing content costs by roughly about 6 to 7%. This year was going to be a much more significant jump to about 10%. And this is just basically Netflix saying that they are willing to diversify into different forms of content. I mean, the big investments that they're making are in live, in sports, in international content, just to kind of keep up that engagement metric and make sure that, they keep building on that competitive moat that they already have. And now, the icing on the cake for them with this Warner deal is that they're getting $2.8 billion in termination fees. So, hey, much more K-dramas, I guess.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.